Mary Holm is in studio with me. Hi, Mary.
Hi, Jesse.
Mary, our personal finance expert, and you've been poring over some numbers this week, Mary.
Yeah, the Financial Markets Authority released its annual KiwiSaver report, and that was a couple of days ago, but I've sort of come up with a bit of a different angle from what other people
Was there
were
much
talking
commentary chat about it?
No, not a heck of a lot, but, that was on Morning Report, etc., and in the Herald and so on, and stuff, etc.
It's a bit of an annual stock take, is it?
It is, yeah, and they're just sort of catching up on the numbers, and they...
I might just move that microphone a little bit closer.
A little bit closer?
Yeah,
sure. The total amount invested in KiwiSaver now is 90 billion, which is a lot of money. But that number doesn't mean that much to people. But what they pointed out is that it's around 25% of gross domestic product. So that's everything produced in the economy in a year. And the thing that's interesting is it's up from 15% 5 years ago. So it was 15% of GDP, and now it's 25%. In just 5 years.
It's a huge growth.
It is. Yeah. It's a big growth. Partly because people are continually putting money in, of course, but also, despite what's just been happening just lately, the returns over the last 5 years have been pretty good, and that's reflected in those numbers. And then there are more than 3 million people in now, with an average balance of about $28,000. That must actually be a median rather than an average, if you know what I mean, because the average would be pushed right up by very big balances in the account. But so it's a median number. In other words, the same number of people who've got less than 28 as have got more than 28.
Got it.
Yeah. So... But then I read out of about 3 million members, more than 1 million are not contributing on a regular basis. And I thought, gosh, that's awful. A third are not contributing. But then you read a bit more and find that non-employees, people who are not putting it in regularly out of their paycheck, are included in the ones who are not contributing, which is not really accurate. And also, I was thinking more and more people in KiwiSaver now are retired, and so they're not contributing, or a lot of them are not. Most of them are probably not, and so it's not necessarily as bad as it sounds when we say a third are not contributing.
When you say non-employees, like someone like me, I don't employ through my wage, but I'm self-employed, and so I'll put a chunk in because you remind me to each year. So I wouldn't be counted as a regular contributor.
That's right.
Saying, right?
And yes,
and lots of people
self-employed.
Yeah.
And people who are not working but it's still in KiwiSaver. Yeah, so those people are not being counted. So it's not as bad as it sounds, but nonetheless there are still a lot of people who stop contributing because they got short of money or something and haven't started again. And that's a real pity because of all the incentives that we all know about. A couple of other things that I thought were interesting about it, though. The main message I got from it was people are taking more risk overall in KiwiSaver than used to. When they looked at switches from one fund to another during the year, they had more people leaving Conservative and Balanced than joining, and more people joining Growth. So in other words, there's a movement from the Conservative and the Balanced, the low and middle risk funds, into the growth funds. And I think that's really good because most people have got more than 10 years before they're going to be spending the money. So it's really good if they're in growth because they get more growth.
Yeah, there was a problem for a while there, wasn't it? The default funds were going into Conservative and people were just leaving them there, even if it was a totally wrong fund for them.
That's right. Well, the default funds have now moved to balance, so they're middle level. But despite that, in fact, the FMA, in this next thing I'm going to say, they removed the default funds because that was a sort of artificial move that happened to everybody late last year. But the growth of money in the growth funds, so 5 years ago, there was not much more money in growth than in Conservative. It was about a bit more in growth than in Conservative in total. And now there's more than twice as much in growth than in Conservative. So there's a definite trend going on here that that the growth funds are becoming more popular, more people are getting into them. So that's
now that could mean people are switching to growth funds,
yes.
but also could reflect the fact that 5 years later, growth funds will have grown more.
That's right.
By
it's
nature,
both. You're absolutely right. Growth funds do grow more over the long run. Certainly not always, and probably not this year, but they do over the long run. So that's quite true. But it's still quite a dramatic change in just 5 years, which suggests, and the numbers of members also show that they are moving into growth funds, which is really neat. Another little sign of this trend of people taking more risk is that there's a small number of people who are in funds that invest in shares only. So they're the riskiest funds of all the aggressive funds, and that's nearly doubled in 5 years, the number of people in the shares only fund. So that's the sort of highest risk level.
I guess that would be a combination of people wising up and realising that maybe an increased level of risk might be good for them, and then
yes.
maybe also some people who are just looking at their returns compared to the returns of those high risk funds and thinking, I'm missing out here.
Hopefully. Some of them have been listening to you and me, Jesse.
Well, that would be ideal.
It would,
but I'm worried if people look at the last 5 years of returns and think, well, this is what I'm guaranteed in the next 5 years.
Yeah.
You hope that when they switch to a high risk fund that they understand that they're not going to get that return every year.
Certainly not every year. Every 10 year, if you look in 10-year chunks, though, they will be doing better.
Yeah.
And in most individual years, they do better. And then, meanwhile, the Financial Markets Authority also had another report that came out in July, and that was looking at everybody in New Zealand over 18 and all the investments they're in. And I was really surprised to see that the percentage of people who are in term deposits dropped a lot. In 5 years, in a single year. No, it's 5. Sorry, Jessie. It was in 5 years. They've gone down from 32% to 20% of New Zealanders are in term deposits, and the same with bonds. Now, that'll be partly because interest rates went down a lot, and people said, I'll blow this.
Yeah, what would be the point, honestly, when you're being paid 0.5 or 1%?
Yes,
yeah.
Yes, it was pretty bad. So people got out of them. Meanwhile, they've been getting into shares in general, not just in KiwiSaver, but shares bought directly went from 19% to 24% from 2018 to now, and non-KiwiSaver funds that invest in shares went from 11 to 17%. In other words, not just in KiwiSaver, but in general, New Zealanders seem to be taking more risk with their investments. And we can speculate why. It will be partly because the returns have been so lousy in the term deposits, etc. But hopefully it is also because people are realising that in the long run they're going to be better off.
Hopefully the financial education which you've been offering for free for many years is finally seeping through, Mary.
Yeah, and many other people, of course, are doing the same.
Yeah.
Yes, yeah.
It's a significant week this week, Investor Week.
Yes, it's Investor, yes. This is, the FMA is saying that it's World Investor Week, and the theme is good investing is long-term investing. And that fits in with what we're just saying, because people should be taking more risk with long-term investing. And the FMA is also saying don't bail out in bad markets, which is incredibly relevant, and possibly relevant to the letter we got today. That, have you got that there?
I do. Let me read it out. Dear Jessie, this is a question for Mary Holm regarding my KiwiSaver investments. I am 71 years old. I'm on National Super. I have a KiwiSaver with a balanced fund. And unfortunately, over the last 10 months, the balance has continued to plummet from $428,264.79 in December 2021, watching it closely, to the current level of $369,402.27. Now, by my rough math, that's about $59,000 that's dropped.
Which is 14%, which is actually not as bad as the numbers look. I think, 14% drop it's a big drop, but there are quite a few years when the share markets grow more than 14%. It's not all that dire.
Yeah.
But still, it's obviously worrying this person.
She says she's made no drawings over this period, and at the rate of this fall, soon there'll be very little left. It's very distressing to see my hard-earned savings disappear in this way. Am I with the wrong investor in the wrong type of fund, and should I withdraw some of the funds and invest in a term deposit? What do I do? Asked this desperate emailer.
Yes, yeah.
They're asking the right person. I know you're going to have very firm advice on this.
Oh, do you?
Not advice.
God, I hope it's good.
Yeah.
What I always say is that money that you're planning to spend within 3 years, roughly, should be in either term deposits or in a cash fund. And now this person, I think it's a woman, isn't it? She's in Westpac KiwiSaver scheme, which is, not a wonderful one, not a terrible one. It's a, fairly mainstream KiwiSaver scheme. Assuming she wants to stay with that scheme, she could think about the money she's planning to spend within the next 3 years or so, and move that into Westpac's cash fund, which is the lowest risk fund. She's in a balanced fund at the moment, a middle risk fund. Move it right into don't hang around with a conservative fund, despite its name. You want to go into the very lowest risk one, which is a cash fund. Westpac's cash fund is about half bonds, half cash, and it's could be quite a good spot for her to move her money into. Just the money she plans to spend in the next 3 years.
Because that money won't go up, and it won't go down, but it won't really go up.
Not a lot.
It's a safe place to put it.
Yeah, it'll go up a bit because interest rates on term deposits, etc., have gone up, and that's what those funds invest in. So what I would suggest she does that with the next 3 years' worth of money. Maybe not moving it all at once, because it's actually reducing your risk at the moment when markets are down is not awfully clever. And the reason her money's gone down as much as it has is that her fund is about half shares and a third bonds, and then there's some other cash and property in there as well. But not only the share market's gone down, but the bond values have gone down as well because interest rates have gone up. We've talked about that before. It's quite complicated, not time to go into it again, but bond values have gone down as well as share values going down. And so despite the fact that she's in a fairly average sort of risk fund, she's seen quite a big drop. That won't continue. It'll ease off and come right. We just don't know when. So she might
Which is why you say the money she's going to spend the next few years,
yes,
take that out.
Yes.
But leave
I'd say leave the rest where it is. But one little tip, because she doesn't sound like someone who would want to be putting some into a growth fund. I think which would give her the longest growth in the long run, but it's more volatile. And if she's worried about this drop she's currently getting, she could get a bigger drop if she was in growth. So we'll skip that for her. But one interesting note I realised was Westpac. She's in Westpac's balanced fund. Westpac has also got a default balanced fund, which has got much the same. It's a new fund that got set up fairly recently, I think. It's got much the same investments, sort of roughly half shares and a third bonds, but quite a lot lower fees. The fees on her current fund are 0.65%, which is not bad. The average for balanced funds is 1.21, so it's only about half the average. But she could, if she just moved into the Westpac default balanced, she'd go from 0.65 to 0.4, which is quite a big drop in fees for much the same sort of fund. It's a slightly lower risk fund, the default one, but that might suit her anyway. Yeah. So I would suggest she moves the 3 years' worth of money into Westpac's cash fund and the rest into Westpac's default balanced fund. And she'll be paying lower fees and she'll get less volatility in the money she's planning to spend soon. And then ignore the volatility in the longer run money because it'll come right.
Yeah.
Yeah.
Yeah, so don't watch that too closely.
No.
Over the next few years.
Yes. It does come right, honestly. It always has and it always will.
And she talks about her hard-earned money, and obviously a lot of that is her hard-earned money, but she's probably done all right out of growth in the last couple of years if she's
Yes.
been in there for the last few years.
Absolutely.
So if she's lost 14% in the last 12 months.
Yes.
She's probably at least gained 14% in the 12, 24 months before that. So
much more than that,
probably still up, yeah.
If she goes back 5 years ago, she will have gained lots more than that. Yes.
Thanks, Mary. You're the best. Mary Holm,
Thanks,
personal
Jessie.
finance expert. Hope that's helpful to our emailer. Another reason for term deposits losing favour, right to one person, is that they can no longer be broken earlier than their maturity unless the investor proves financial hardship. This lack of liquidity concerns people in these uncertain times. Don't have time to fact check that. I'm just reading that out as it comes in. Dangerous game.